Okay, let's dive into this. I've got some news that might literally change how you view your financial future. It's a startling fact, but it is entirely true. Canada does not have an official inheritance tax. That sounds like a massive win for your hard-earned wealth, right? Well, the reality is your estate could still be heavily exposed to taxes when you die. It's this hidden exposure that absolutely shocks families every single year. In today's Explainer, we're going to unpack exactly how the government takes its share and, more importantly, how you can step up and protect your legacy. Here's the roadmap for today's Explainer. We'll start with the inheritance tax myth, move into the deemed disposition reality, see the tax bite in action, cover immediate tax-saving strategies, and finish up with the life insurance solution. After we define these heavy tax problems, I promise we're going to focus heavily on both immediate and advanced strategies to actually protect your wealth.
All right, part 1. The inheritance tax myth, what everyone in Canada gets wrong.
So unlike the US, which only taxes massive estates over $15 million, or parts of Europe where recipients pay the tax directly, Canada is, well, it's unique. Because there's no official inheritance tax, there is this widespread middle-class myth that there are zero taxes at death. But the harsh reality? Canada uses a hidden, almost invisible tax system called deemed disposition. It builds a massive tax bill right into a final tax return. Because it isn't labeled as an inheritance tax, families are completely blindsided. I mean, a recent news story highlighted an Ontario family who got hit with a $660,000 tax bill after both parents tragically passed away in the exact same year. No way around it. That is the reality we're dealing with here. Section 2. The deemed disposition reality. Taxed before you pass. Now, what's really interesting about this is exactly how the CRA evaluates everything you own at the end of the line. So what does deemed disposition actually mean? Well, it's a rule where the CRA treats your assets as if you sold almost everything you own at fair market value the literal second before you die. Now, there's one piece of genuinely great news here. Your principal residence is entirely exempt. But everything else, your second properties, the family cottage, your non-registered investment portfolios, those are completely exposed. All of that simulated selling generates capital gains, which are then slapped directly onto your final income tax return. Before we look at some real-world numbers, we got to talk about probate. Probate is simply the legal court process that confirms your will and authorizes your executor to act on your behalf. Compared to deemed disposition, probate is a pretty small fee. For example, on a $500,000 estate in provinces like Ontario or BC, you might owe around $6,000 to $7,000. Quebec even just charges a small flat fee. But still, it eats right into your heir's inheritance and can drastically slow down the whole distribution process. Section 3. The tax bite in action, real-world case studies. Let's look at exactly how devastating this can be for everyday Canadians. First up, meet Carol. Back in 1990, Carol bought a beautiful cottage in Muskoka for $250,000. Fast forward to today, it's worth $850,000. Under deemed disposition, that $600,000 gain is fully taxable, meaning her estate owes around $150,000 just on the cottage. Add in a non-registered investment portfolio with its own $250,000 capital gain, and combined, these virtual sales push Carol straight into the highest marginal tax bracket, a whopping 50% in Ontario. Next, there's Dan. Dan passed away at age 70 with a $400,000 RRSP. And since he didn't have a surviving spouse to roll it over to, that entire $400,000 was taxed as income in a single year. You know, it's literally treated as if Dan earned a $400,000 salary in his final year of life. The result? A staggering $180,000 tax bill paid directly to the CRA before his kids even saw a single penny. Finally, consider Jane. She's a small business owner who built a $2 million manufacturing company completely from scratch. Her starting shares were worth almost nothing. Because the CRA taxes the growth and value of company shares as a capital gain, Jane's estate is staring down a massive six-figure tax bill. If you're a business owner, this right here is why planning ahead is absolutely non-negotiable. Let's do a quick mental palate cleanser here. Who actually writes the check for all this? It's not your beneficiaries directly. The executor of your estate is the one who gathers your assets, files that final return, and pays the CRA directly out of the estate's bank accounts. Or, worse, by being forced to sell assets, like having to put that beloved family cottage on the market just to pay the tax on it. So technically the estate pays, but practically, your family just inherits significantly less money. Section 4. Immediate tax-saving strategies. Steps you can take today. So the crucial point is you don't have to just accept this scary tax hit. Let's look at some actionable steps. Let's rapidly rattle off some highly effective DIY strategies you can use today. First, give cash gifts while you're still alive. There is zero tax or attribution on this in Canada, making it an amazing way to help a child with a down payment today. Next, utilize joint ownership, but do it carefully. Keep those beneficiary designations perfectly up to date on your TFSAs and RSSPs. Naming a spouse or disabled child directly bypasses probate and administrative delays. You can also look at triggering capital gains early while you're in a lower tax bracket, and absolutely use the spousal rollover for RSSPs to defer taxes. Finally, for business owners like Jane, take advantage of the generous $1.25 million lifetime capital gains exemption to shelter your shares. Section 5. The Life Insurance Solution Advanced Estate Planning with Galen. The source material introduces some brilliant advanced concepts from an estate planning expert at Blueprint Financial named Galen. He uses this fantastic bucket analogy. You've got the red bucket, that's your fully taxable environment. Your RSSPs, RRIFs, real estate, these are the assets that just explode your final tax bill. Then you have the green bucket, your tax-free environment, things like TFSAs and life insurance payouts. At its absolute core, Galen's strategy is simply to start systematically moving your wealth out of that highly taxed red bucket and right into the tax-free green bucket. Let's break down one of his real-life case studies. He worked with a couple who had $300,000 in savings, but 80% of it was stuck in that heavily taxed red bucket, their RRSPs. Only 20% was sitting in the green TFSA bucket. They ran the projections and realized they weren't even going to need all that RSSP money for their own retirement. It was just excess savings sitting there, waiting to trigger a huge tax bill that would eventually gut their daughter's inheritance. So here is the exact mechanism they used to fix this. Step 1, calculate exactly how much excess savings were in that RRSP. Step 2, instead of pulling it out all at once and taking a massive tax hit, they began withdrawing small, manageable yearly slivers. Step 3, they deposited those after-tax slivers directly into a permanent life insurance policy. Now, getting this set up does usually require answering a health questionnaire or maybe doing a paramedical exam, but once it's locked in, it leads to step 4, passing that wealth completely tax-free to the beneficiaries. Contrast this with leaving money in an RRSP. If you leave money in an RRSP, the tax bill still hits your estate, causing delays and headaches. But a life insurance payout, it is completely tax-free. Plus, it completely bypasses the slow probate process. We're talking cash delivered straight to your beneficiaries in just 5 to 10 business days. And this brilliantly illustrates the jaw-dropping climax of Galen's case study. If that couple had done nothing, just left their wealth in the red bucket to trigger deemed disposition, their daughter's inheritance would have been ground down to roughly $115,000. But by systematically moving slivers of wealth into the green bucket via the life insurance strategy, her inheritance jumped to completely tax-free $400,000. It is the exact same starting wealth, just structured intelligently. Now, to remain entirely impartial here, the source material makes it clear this isn't a magic bullet for everyone. If your plan is to spend every last penny during your lifetime enjoying every drop of that RRSP, then life insurance simply doesn't make sense for you. Same goes if you don't have any desired heirs or charitable causes you care to support. This strategy is specifically designed for folks with excess savings who want absolute maximum efficiency when passing it on. Which brings us to our final thought for today's explainer. Take a hard look at your own wealth. Look at your own red and green buckets. Have you calculated exactly how much of your life's work the CRA will claim when you're gone? Because the hidden tax of deemed disposition is real, and it is aggressive. But, as we've seen, with the right planning, you hold the cards. You get to decide how much of your legacy goes to the government and how much goes to the people you actually love. Take the time to evaluate your estate and make sure your wealth is doing exactly what you want it to do.